I'm here with Dougal Maple-Brown. Dougal, we've seen a lot of volatility in the markets over Q3. Why has it been so tough for value buyer strategies?
Thanks, Duncan. Before I go into why it's been so tough, I think it's important for investors to get a feel of how tough it's been over a long period of time. You see this chart I've put up now is actually US data going back over 60 years, which shows the value drawdown has been as great as it's ever been at approximately 50% cumulative against the market. And the second point, it's been happening for a very long time. In the US, on the chart, you can see it's been going for 13 years. Again, the longest value drawdown in the 60-year history of the chart. Turning to why it's been tough, there are a myriad of reasons, but I think the two most important ones are firstly the fall in interest rates. So as interest rates fall, all asset classes get a kick, that's clearly right. Within our Australian equities market, however, some assets, some stocks do better than others. And frankly, the longer duration the cash flows, so the more they are out in the future, the bigger kick they get from falling rates. Now in an equity context, that's growth stocks, which by definition have cash flows further out in the future, do better than value stocks. The second reason, I think, which has happened frankly around the world, probably everywhere except the US, is that the economic recovery has been very tepid for the last decade. There's been very little economic growth, and in fact, looking at many of our stocks, there's been very little earnings growth over that decade. Now, historically, value has done better in a cyclical recovery. Frankly, we haven't had a cyclical recovery in Australia, or indeed many parts of the world, for almost a decade now.
Some say value is dead. What has changed in your view?
2 points. First of all, I'll go back to what has changed, what's caused this malaise. So look at interest rates, for example. They have come down in this country to 25 basis points of the cash rate and less than 1% for the long bond. Depending on how far back you go, most of the interest rate damage has been done. It's come from up here to down here. Of course, it can go lower again. Rates could go negative. But from where we sit today, most of the benefit from the fall in interest rates has already been taken by those growth stocks. The second reason is what I call the elastic band. When you look at valuations, and you can see on this chart, which splits the market into the most expensive stocks and the cheaper stocks, and compares the PE spread on that cheapest and most expensive basket. Now this is a 20-year chart, and over time that spread has been about 12 or 13 PE points. So how I read that is the cheapest stocks are traded at about 10 times earnings and the most expensive at 22, 23, 24 times. What's very clear from the chart is that spread has gone almost vertical over the last couple of years. So that spread has blown out to about 35 PE points. For the mathematicians out there, today it is about 3 standard deviations high, which is, I had to Google this, 99.7% of occasions. An elastic band will stretch so much. It is very hard to predict when it will break, but when it is very stretched, it will ultimately break at some time. And that's what the valuation charts are telling you at the moment.
We've just been through Q3 reporting season. What were the major surprises?
The reporting season was a real mixture. The companies reported periods pre-COVID, in the middle of lockdown, depending on where your business was, in different states, different countries around the world. And it was very hard to get, in my view, very hard to get a clean read out of reporting season. What has been interesting to us, which has happened over the last weeks and months, is that there's been a lot of corporate interest in a few of our beaten up value stocks. And this is quite heartening. When competitors, when peers start looking to buy assets, companies, when even, dare I say it, private equity starts looking to make a move on listed companies, that's showing you how much valuation support there is for some of these stocks. So in our portfolios, we typically hold about 30 stocks. We've had 4 stocks either under takeover or M&A interest in the last couple of weeks. So in case of Boral, the Seven Group took a 20% stake. Helios sold their largest division of medical centres. Janus Henderson, an active shareholder, took 10% of it. And then finally, just this last week, a full takeover bid for Link. This gives us quite some encouragement that the valuation support that we've seen in many of these stocks for some time now is now being recognised by third parties.
So why do you think we're seeing a lot of this corporate activity?
I think in essence, Duncan, is that interest rates are low, capital is cheap, and many of these stocks are cheap in a relative sense, and that's finally now being realised.
Given what you've just said, Dougal, what's the upside opportunity?
The drawdown has been as big as it's been in history, and frankly, we see the upside in the same light. And what I take comfort from 2 things. First of all, our history. Our firm's been going since 1984, and there have been a couple of times when our underperformance has been as bad as this, and that was in the tech bubble, and that was in pre to the GFC. In both those times, performance recovered very strongly, and we are fairly confident this will happen again here today. The second, and this is a forecast, so we can't be as sure, but the forecast alpha from our analysts bottom up on our portfolio is as large as it has ever been in our history. So we think the spread between our portfolio in the market is as wide as it's been. In essence, this has been a record drawdown and we are forecasting a record recovery. When that will happen, who knows? But value has become such a small niche strategy with everybody playing on the growth side, then when the turn comes, and it will come, then the upside will be big.
Just on that point, do you think there is a high correlation across investors' portfolios?
I think, to put in casino terms, all the money is on red and no money has been put on black, the value strategy, and that is a risk for a lot of investors. Just as the country's endured a tough run with the pandemic, so has value investors. But with valuations so stretched and all the money on one side of the table, now is not the time to give up on value.